Tihei Moriora, Ingamana, Ingareo, Eiro Rangatira Tēnā koutou, tēnā koutou, tēnā koutou katoa. Thank you, Simon. I feel tired now. Look, and thank you to Payments New Zealand for inviting us and for hosting this conference. Payments are highly interconnected by nature, so it's fitting that we're all here connecting, including with the regulator, or one of the regulators, and listening to one another and discussing the hot topics in payments. So, it's a fascinating collection of subjects, and I'm looking forward to the rest of the day as it goes on. But as Simon said, today I want to talk about the question of whether a central bank should issue a digital currency, whether that makes sense. The payment system and the way we view money is changing dramatically with new financial technologies. As we've heard, as we all know, we initiate payments in an incredible variety of ways. And cryptocurrencies and blockchain are part of that total set of options, if you like. Are banknotes passé? I liken this period of technological and financial innovation to an earlier time when exploration was fast-paced and the stakes were high, the 1860s and the gold rush of New Zealand. The 1860s gold rush saw a huge search for wealth. It fueled speculation in lots of different ways. It fueled very similar in some senses to the speculation in cryptocurrencies. But beyond that particular facet of this technological financial innovation, there is this fundamental question: where does a central bank fit in? Should it enter this terrain and issue a digital currency of its own? The Reserve Bank has a proud record of innovation, and we welcome technological change. A digital currency would be attractive to us if it could improve our currency distribution, payments efficiency, and monetary or financial stability functions. But these benefits are by no means guaranteed, and they might not come without cost. So I want to explore the pros and cons, as we must, before we make a decision on whether to issue a digital currency. Like the prospectors in the gold rush, I want to take you on a journey of looking to see whether there's something here of real value, the gold or the fool's gold, perhaps. So I'll start by describing exactly what I mean by a central bank digital currency, and then I'll explore how issuing such a thing could impact on some of the core central bank functions by answering three questions. What is issuing a central bank currency? What would that mean for currency distribution? Would it improve the efficiencies of the payment system? And would issuing a central bank currency fit with our financial stability objectives, or would it be at odds with them? To answer these questions, and to draw from the material published in three Reserve Bank Bulletin articles recently, written by Amber Wadsworth, who's here with me and the source of this speech substantially. So I want to thank her and acknowledge that work. And then finally, I'll touch on our prudential regulatory responsibilities with digital currencies. Let's start with a concept of money, as Simon alluded to. What is it? Well, normally we think of money as having three basic functions. A unit of account, something you can compare dissimilar goods and services with, puts them in a common metric. Secondly, it's a means of payment, being able to exchange something for something. And thirdly, it's got this property of being a store of value, that you can hold this thing over a period of time and it can still pay for something or other. So those are pretty important properties to keep in mind and think about, and we need to, they relate to underpin, in a sense, the rest of this talk. I mean, forms of money have changed significantly through time. You've got the top picture there of the Yap stone, which was an object that served those purposes. It wasn't particularly easy to exchange, but it certainly, things were measured in terms of stones, and they held value, and they were sort of regarded as something that you knew if you had one of those, you could exchange it for all sorts of other things. Cigarettes in a prisoner of war camp have served this purpose, gold, of course, and banknotes. So some of them perform some of those functions better than others, but they all have these sort of intrinsic properties of being a common payment metric, that unit of account and that store of value and means of exchange. Common feature to them all is a trusted use. They all have, and we've heard that word a lot already this morning, that sense of trust that they can be used in those ways through time. So when I mention digital currency or digital money, and I'm going to use those words sort of interchangeably, currency and money, some of you might immediately think of cryptocurrency. It's a digital currency. But some of you might also think of your digital account balances. You have digital money when you look on your phone and see your account balance at the bank. Others might think of a credit or debit card. In fact, I'm referring to all of these things, all electronic forms of money that enable you to pay something and represent a store of value. And we can sort of categorise money through this money tree that Amber devised, in which you can see in this, in one branch, physical money, and the other branch, digital money. And digital money then sort of branches off again into two different forms we can think of. Those that are the conventional digital currencies, which rely effectively on existing infrastructure and are operating in the sort of, at least in New Zealand, in the New Zealand dollar, fiat currency form. And then on the other branch, cryptocurrency, which broadly speaking rely on some cryptography and most commonly on a distributed ledger technology. So I want you to keep both of those branches in your mind as I talk on, because I'm going to sort of refer to them and draw on the properties and pros and cons of each of those branches. The most common example of privately issued conventional digital currencies are bank deposits. These electronic deposits carry a promise to be converted to fiat money. You can convert them into cash at the par value, 1 for 1 of the cash. So this makes them very stable. The most common form of privately issued cryptocurrency, as we probably know, is Bitcoin. These are quite different and separate in terms of value from fiat currency. They don't have that convertibility at par, and they have, of course, this notorious price volatility. But that's not necessarily so. We could create a cryptocurrency that does have par value. So then, let's think about a central bank issued digital currency. If I've talked about private ones, the conventional and the crypto form. At the moment, the only way central bank money is sort of created effectively is electronically through a settlement account at the Reserve Bank. So banks have access to that. We restrict access to that to certain parties. It doesn't have to be a bank per se, but it has to be somebody that we are prepared to authorise to have access to that reserve account. And so that's a restriction, and it really only operates at the wholesale level. That money, enters into the banks, the wholesale level, and then they can deal with customers at the retail level through bank deposits and those mechanisms. To be truly transformative, a central bank digital currency would be open access to individuals and firms to deal directly with the central bank. So effectively I've got here 6 assumptions that I want you to understand when I'm talking about a central bank issued currency. And this is the first and foremost one, that it's actually access to all. So, the digital currency could take a number of technological forms. It could be an account at the central bank, and you could have your money put directly into it. You could put your money into it at the central bank, have it there. Or it could be a token or a card that could be put on, but with backed and vouched for and under the sort of auspices of the central bank. So, this is a different feature. This is sort of putting the central bank right in the personal account deposit taking place in the monetary system. So it's a fundamental feature, and that's one of the reasons why it needs a lot of thought about how much this impacts the total monetary and financial system. The second assumption is that this digital currency this could be either cryptographic, a cryptocurrency, and use distributed ledger technology, or it could be a conventional digital currency based on the existing payment infrastructure. So it's not deterministic. It doesn't have to be either of those. It could be, it doesn't have to be a particular one of those. It can be either of those as a central bank currency. So don't get in your mind that it has to be crypto. It doesn't necessarily have to be, but it could be. The third key assumption is that if we did issue one, we would be issuing it alongside banknotes and coins, I suppose, and private monies, that at this point we're not thinking about it completely replacing. I'll talk about this as we go on, but effectively it's in conjunction with. We're not planning, we're not intending that we would remove cash under this model. The fourth key assumption is it would be convertible to cash at the fixed par rate, exchange rate. This helps it to be trusted, its value, it's easy to utilise, and it also simplifies the world. We don't have exchange rates between the two. Fifthly, we're assuming you wouldn't actually be able to borrow from the Reserve Bank. You'd have to have a positive balance in this account. And this is an important assumption. And finally, we're also assuming we wouldn't be paying interest on this account. And again, this is quite an important assumption. Some of the advantages of the digital currency actually diminish if we had to pay interest. There are other advantages that possibly could increase, but it certainly would complicate the world of banking if we were paying interest on a straight deposit account at the central bank. So we're assuming we're not. So then what I want to do is say, if you've got that picture in mind, effectively the central bank is holding this, your accounts. You have an account at the central bank with money in it. Everybody's available to have one. How does this stack up against the system that we have now? I'm going to look at it against three key dimensions, as I said. The first is currency, and I'll look at that. Then I'll look at the payments, and then I'll look at financial stability. So in terms of currency, look, actually there are some advantages. The current system we have for distributing cash is somewhat cumbersome, somewhat dangerous, somewhat costly. We have to distribute cash around this country, geographically dispersed, get it to people in ways that are not always easy, certainly not costless, moving cash from Auckland to Invercargill and vice versa. We have to check the quality of it, inspect it, all of those sorts of things. So issuing a digital currency would have some advantages. It would reduce those costs of distribution, we believe. It would require, however, that we build an infrastructure that allowed us to do that. You can have the account system, the token system. So it's not costless. It shifts costs into a different way, into an investment sort of cost model, but then it's probably cheaper to distribute on an ongoing basis. Also has a downside that, you can lose cash, have thefts of cash, but you tend not to carry huge amounts. If you have a whole lot of money on a token or in an account on your phone and it's central bank currency and you lose it, you've lost it. Truly lost it. It would be quite hard to regain it. So, that's a consideration. Thirdly, an electronic system has some points of vulnerability in terms of credible reliance on our infrastructure providers, our power system, electricity system, our communication system, and so forth. And so, for example, when we had the earthquake in Christchurch, there was an incredible rush to cash. The ability to use the electronic system was unavailable for quite a period of time. And so cash actually has some advantages over those things. But, this is there are pluses and minuses in the current cash system. And New Zealand's an interesting place. Despite our incredible number of electronic means of payment, cash is still being utilised quite significantly and still growing. It's around the amount of cash on distributions, 2.7% of GDP, and it is still growing. We recently did a survey of cash use. We found that 96% of people claimed they still used cash. 80% of those used cash every week, or used it actually in the last week, to be strictly true, and had some cash, and 80% had cash in their wallets. So it's still quite used, but nearly all of those people also used other forms of payment, electronic forms of payment, and they tend to use those more. Only 10% of the population used cash more than 7 times a week. So it's used, and it's maybe a backup, but it sits there. Also demographically, and I know this was in the questions that Nadine was touching on earlier, we did find that people over the age of 60 do use cash more than those under that age. So, it's still got a property. But it's in lots of places in the world, and you see on that chart, in Sweden, cash use is diminishing very significantly. And if it falls dramatically, then retailers, banks may be less incentivised to hold it, to have those costs of managing it. And so potentially a digital currency, would be beneficial. So I suppose if I stacked it up on terms of the cash use, on benefit, we can see some upside, but it's not a substitute that would completely replace cash in the foreseeable future. If I turn to payments, then at this point, there are a lot of electronic forms of payment that work very efficiently as they are now. If we were to issue a central bank currency, and I'll do it here first in terms of blockchain type distributed ledger technology, the short answer is it would be less efficient. Blockchain introduces some efficiencies into the system. It's unique because there's no central agent managing that system. It's unique because it joins the settlement and payment components of a payment system into one step, and therefore actually reduces the time in settlement. But of course, it's less efficient and slower in terms of payment. It lacks currently scalability and the ability to produce a number of payments and service them at the time, anywhere near the time of the current payments infrastructure. And there are some facts there to show that. So if I sum that up, in terms of a blockchain currency would have the advantage of being more, and distributed ledger would have the advantage of being more resilient in a system sense, because there's no single point of failure. We have benefits probably in some cross-border transactions, but has these significant disadvantages at this time in terms of its payments facility. A central bank could try and overcome some of those by centralising the system. It doesn't have to put the central bank at the heart of the blockchain, having in the technical terms a node that was ours, a permission system rather than the permissionless system of Bitcoin or most blockchain distributed ledger technology, but one that we controlled the access to the accounts, knew who they were, what they were all doing, centralising that system. But at that point, it's a very similar system to the current payments systems and doesn't really have a lot of advantage over them. And some other central banks have been looking at this and they've concluded that there's no obvious gains from such a system over the current payments systems. So then if I turn, that's a sort of a bit of a negative answer to a blockchain DLT form of central bank digital currency. If we had a conventional digital currency using the existing infrastructure and payment system, again, we'd get some advantages, some improved settlement speed probably, potentially lower fees. But we'd also still need some exchange systems for cross-border transactions. It would be a system that would put more onus on the central bank to do what the current system does, but probably doesn't offer a lot of benefits at this point. So I'm going to traverse this fairly quickly and just say that that we don't see a lot of gain in it, but it would be a substitute. So then I want to talk about the financial stability dimensions. This is a really key aspect for us as a central bank, as a supervisor, regulator of the banking system. One of the most important responsibilities of the central bank is in its contribution to a country's sort of well-being and prosperity is that responsibility to ensure the financial system operates soundly and efficiently. A breakdown in that system causes enormous harm. So we wouldn't issue a digital currency if we thought it was going to undermine the financial system. And banks, as much as they are maybe being disintermediated in some ways, are still a very, very critical part of the financial system. In New Zealand, they are by far the dominant feature. The thing about a central bank digital currency and the way that I described it, accounts at the central bank, if we offered that, it offers you, me, everyone, a very safe asset. You can put your money with the central bank and know that it is safe. That's a good property. The problem is it's in competition with the banks, and the likelihood is that deposits would flow from the banks to the central bank. They would almost certainly do that if the bank was under stress, if there was some threat to the prospect of that bank. So in that sense, the central bank's operating in competition with the banking system. In a way, it's a good thing. It's offering an alternative safe asset, but in another way, it's sort of undercutting the banking system. So, we worry about that. We actually see three major risks. We see the risk that banks would face higher costs of competition. They would have to compete for those safe assets. That tends to drive them to a riskier yield searching activity. Where can we make higher returns? That's a bit riskier, typically. It would tend to drive them to more wholesale overseas funding, which is also less stable, tends to freeze up in financial crises. So the banks are a bit more vulnerable under these circumstances. And finally, as I said, it would put the banks more at risk in the sense of a bank run of deposits running to the central bank. So at this point, when we look at these financial stability implications, they may be solvable in future. We may find ways to diminish or reduce those, but for now, we see greater risks than we see benefits. I'm just about ready to conclude. I'll just touch on very briefly regulation of privately issued currencies. Just really to make the point that we actually don't have any plans at this point to introduce any new regulation of cryptocurrencies. That they're too small at this point in terms of their materiality, significance to the financial system to worry us, need for particular regulation. There are, of course, some consumer regulation responsibilities of the Financial Markets Authority already in terms of issuing an initial coin offering. And there is existing AML, CFT legislation applying to them, but there's not particularly a prudential supervision regulation, and we don't intend to. So just let me conclude, because in a sense what I've given is a message that says, well, we're not going to issue a digital currency right now. I want to make clear that we do see real scope for innovation and efficiency gains in the payment system. We do think that a digital currency is a real prospect at some time in the future. But on balance, at this time, the pros and cons of central bank digital currency are mixed and more risk than upside right now. So we do have an open mind about this. It is an ongoing search for something that can improve the world that we operate in, an ongoing exploration for some gold that's out there. We want to keep searching for that, keep looking at it, but not be naive about it. We have been looking for the gold in this technological world that we're in. Is there a frontier here that we should be very close to, be part of? Right now, the answer is no. Distributing a central bank digital currency could give some gains in currency, could give some gains in payments, but it could also bring some cons. And in particular, there could be some negative financial stability implications. The payments industry is dynamic. It's continuing to innovate. The Reserve Bank will continue to be a participant in that innovation, a prospector in this world. We'll continue to look for opportunities and join with you in the search for improvements to our payments and money systems. Ngā mihi, nui kui, a koutou. Thank you.